Let's talk about what happened today in the markets and what we can expect to happen over the next coming weeks. So let's dive into all of this information. If you guys find value out of the channel, hit that like button, subscribe to the channel. If you guys are new to the channel, we cover what happens in the stock market on a daily basis, give you guys the most comprehensive, up-to-date information that most of the time turns out to be true. I'm not a fortune teller here, but we do have a very strong track record on predicting major events such as the Fed and even on a week-to-week basis. Now, if you guys want to come trade with me live in real time, link down below in the pinned comment. Thank you guys for tuning in. Enjoy your weekends, but let's get to it. So the S&P 500 is up 0.65% here on the day. The Nasdaq is up 1.68%. The Russell 2000 up 1.36%. Yes, this might look like a little bit of relief after seeing so much pain recently in the markets, but in all reality, we have not done anything. We're still at the lows of 2022, and this is still the second worst closing day of 2022. The first worst closing day of 2022 was yesterday, where we did close the day at $365.07 on the S&P 500. We are about $2.35 off of that right now, heading into the close, so I doubt we're going to close under those levels, but we are still sitting at the lows of the year, and it has been a very, very bad year. The QQQ year to date is still down over 31.30%. That is bad. That is very, very bad. Why have the markets been freaking out? Because we're heading into a recession. The Fed's going to be raising rates into a recession, and the Fed essentially sounds clueless. The Fed, during their press conference, when Fed Jerome Powell was asked questions, there was a couple things he said that just didn't make any sense. Like, they're not trying for a recession. They don't see a recession. And then in the summary of economic projections, the Fed expects 1.8% GDP growth for 2022. How is that even possible when the economy contracted 1.5% for Q1 2022? The numbers, the data, they're not making sense. And what has specifically caused a lot of fear as well over the past couple of days has been the largest bankruptcy over the last 2 years, which was Revlon, a well-known company, a well-known brand for almost 100 years now, declared bankruptcy yesterday. Good news today, they actually found a buyer and someone wants to buy Revlon. So that is part and part why the markets are reacting bullishly today. But overall, can I be honest here? It's still a shit show. You're still down dramatically. Your portfolio is still beaten into the ground. But what can we expect heading into the future? To be quite honest with you guys, probably a short-term bottom for now. But once we get cranking throughout the rest of the year, it's not going to be a good thing. And specifically what I'm looking forward to, I shouldn't say looking forward to like it's a good thing, but looking forward to in the sense of what's going to cause the markets to freak out even more. It's going to be the realization of, hey, we're in a recession with high inflation and the Fed is going to continue raising rates. The Fed, unfortunately, is probably not going to stop raising rates until inflation comes down to a certain point, or that they can reasonably expect that if they did nothing, inflation would still come down. The Fed is not your friend. It has not been this way since before 2008. So it's been a very long time where people have essentially had the Federal Reserve here to backstop the markets. Well, the Fed cannot be a backstop to the markets when inflation is this high, and you are essentially waiting for a perfect storm, and that perfect storm is right around the corner. Now, why I think a short-term bottom is in, because we're not quite to that place of declaring a recession and the Fed continuing to raise rates. We can technically go into a recession as soon as July 28th. That is when Q2, basically advanced estimates come out for GDP. July 28th. Mark your calendars for that day. That is the day that we could possibly go into a technical recession. So I do think from now until July 28th, there is a decent chance that we're probably going to see some level of a market bounce. Maybe it's 5 or 10%. And then once we get possibly to July 28th, it looks to me like we're probably already in a recession. If it is confirmed we're in a recession, that's when you could see more pain to the downside. Now, a lot of people like to talk about the VIX, and this is something I want to talk about. The VIX does not have to spike to hit a bottom, and why I say this is because the VIX, the volatility index, essentially tracks the S&P 500 calls and puts. What calls and puts are, and specifically puts, they are insurance on your portfolio. The way that hedge funds like to actually use puts are hedging for the downside to protect losses in the case of a market crash. Well, if the markets have slowly been crashing, and this has been a very televised event, and there is historic record levels of cash on the sideline and record low levels of long exposure to stocks, why do you have to buy insurance on a portfolio that already has insurance? Because there's no long exposure or very little long exposure. There's a lot of cash in these portfolios. You don't buy insurance on cash with put options, right? So the VIX spiking, this is a false narrative of actually seeing a bottom. I do think the VIX will spike to a certain degree, but it does not have to ultimately get that bottom. That's something I hear all the time that I wanted to clear up here in this video. Now, on top of that, what can we expect over the next coming week? Well, not a whole lot, to be honest with you guys. For the economic calendar for June 20th, I believe the stock market is closed on Monday, so keep that in mind. It is going to be a shorter week, but on Tuesday you do have existing home sales, some more real estate data that comes out, Chicago Fed National Activity Index, a couple other things that can be a little bit more important than not, but that's basically it for Tuesday. For Wednesday, you have the inflation rate for the UK, which can be important, Canada's inflation rate, which could also be important for global monetary policy, right? What is the UK going to do? What's Europe going to do? What's Canada going to do? That can be somewhat important for American markets. You do have some MBA mortgage data that comes out on Wednesday as well, but nothing too crazy. Now on Thursday, you do have some more European data, S&P Global CIPS Manufacturing PMI for the UK, same thing for Germany as well. Now, Thursday, 7:30 in the morning, you have current account for Q1, initial jobless claims, continuing jobless claims. You do have some Kansas Fed composite index data that is coming out, some gasoline data that's coming out, natural gas information that is coming out, 5-year bond auction. That could be pretty important for the trajectory of where rates are going to go, but nothing else. On Friday, you really don't have much. New home sales for May, Michigan consumer sentiment. That's going to be probably the biggest catalyst of this whole entire week. Coming on Friday, Michigan consumer sentiment information, new home sales month over month for May as well. But if you guys haven't got the gist yet, there's not a lot for this upcoming week. It's going to be a very slow week in that regard. Now, the week after that is when we're going to get more data that's coming out that will be more important for the markets. But the biggest thing, probably that Michigan consumer sentiment, that's going to be pretty important in my personal opinion. And data here is going to be king. Inflation reports, PPI reports, PCE reports, manufacturing data, retail sales, all of that will be very important because it's a race against time. When do we go into a recession? The quicker that happens, the quicker the data starts to turn in that direction, the more pain we are going to see in the markets. And Fed Jerome Powell basically quit. During his last press conference, he basically quit, not in the sense of resigning from his position, but he's saying whatever the markets price in, we will do it. Even if a bad piece of data comes out and then 2 days later, like we seen last week, the markets start to price in a more aggressive rate hike, the Fed will do it. So if the markets start to get a lot of bad data between now and July 27th, the next Fed meeting, which is very interesting, the day after that we could go into a technical recession. Very, very interesting right there. The timing on that couldn't be better or couldn't be worse. Probably couldn't be worse. That's probably what we're going to say. But if we do start to get data that comes in bad and it starts to change the expectations of what the markets expect for interest rate increases, that's where you're going to see a lot of problems, because the markets start to price in a 1% rate hike or back-to-back 75 basis point rate hikes. That's what the Fed is going to do, even if they only have a day or two, to let that get priced into the markets. And that's essentially what happened last week. CPI report came out on Friday. By Monday, markets were expecting a 75 basis point rate hike. That's exactly what we got. Something else you want to pay attention to is where the long-term rates are looking like. Not long-term, like 10, 20 years out, but what they look like for a year from now. July 26, 2023, that Fed meeting, we are expecting rates to be in between 3.75 to 4%. Given what is essentially happening with market expectations and what the Fed is basically going to do when market expectations change, if you start to see the Fed and the markets pricing in 5% or 6% or 7% federal funds rates by that time, that's what is going to happen, and that's going to be the terminal rate. Essentially, this is the rate where the markets think, hey, the Fed will get the federal funds rate up to, and then they will stop raising rates. If that rate becomes higher and markets expect it to be 5, 6, 7%, like I just said, that's where you could see a lot more pain here in the short term and even in the mid-term future. So that's what really happened. You want to watch the bond markets. Today, the bond markets did come down. Bond yields are down 0.07%, and that is definitely helping out the markets today. And it's actually very interesting because the bond yields have been falling over the last couple of days, and we have still seen some very red days over the past 2 or 3, 4 or 5 trading days now. It's been a pretty big move from where we were just at, call it June 6th. We are down about 11% since June 6th, about 11 days ago. So on average, you're falling about 1% per day, and not even including the weekends. So exclude the weekends there, you're really on average falling like 1.5% over the last 11 days. It's pretty bad when you put it in that perspective. So a little bit of a relief rally here today. Markets are in their last couple of minutes, so we'll see where things do end up hashing out at, but it looks like we will definitely close on a positive note. That's what you guys have to look forward to heading over the next couple of weeks, specifically over the next week. There's not too much. It's really going to come down to what do the markets price in for the federal funds rate. But overall, I do think this is a short-term bottom, and I do think we could rally another 5 to 10%, possibly back up to these levels on the S&P of, call it 400, 410, and then we're probably going to get some more downside once we get more bad economic data. And why the only reason why I think this is a short-term bottom is because you're already down 31.5% for the NASDAQ in 6 months. These kind of crashes, they're not a straight line down. They're a very bumpy road down, and then ultimately a very rocky road back to the upside. And this is going to take a considerable amount of time. So make sure you guys keep that in mind. It's not going to be a V-shaped recovery. This is your opportunity to build wealth in a very massive way, and hopefully in the next year or two you can accumulate large positions, and then in the subsequent following years you will be in a much better place, and hopefully all multi-millionaires. So that is going to be all for this video. Hit that like button and subscribe to the channel if you guys found value out of this video. Make sure to source your comments, questions, or concerns down below in the comment section. I would love to hear where you guys are at with everything I just said. Do you think we're in for a short-term bottom? More pain? Do you think the economic data matters? The federal funds rate, where do you think it's going to be? How do you think the situation is going to evolve? Source your inputs. It helps me come to a better input for myself as well, and everyone else down there. I think you find a lot of value even reading comments here on YouTube. So check all of that out. If you guys want to come trade with me live in real time, link down below in the description of this video, as well as that if you guys want to get your free stocks with Webull, Moomoo, and Public, also link down below in the description of this video. Thank you guys for watching, and I will see you in the next one.